do you think? Can you see the similarities? This week we're going to talk about bull flags, bull pennants, bear flags, bear pennants. We talked about triangles last week. Those are continuation patterns. These are continuation patterns. So just like triangles, you have to have the proper trend prior to the actual move in order for it to be a valid price pattern. We're going to talk about bull flags first, and then we'll talk about bear pennants. A bull flag, like I said, you have to have, a bull flag obviously is a bullish price pattern. You have to have the uptrend prior to the actual move for it to be valid. Then you're going to see this quick spike to the upside, and that spike takes place on a nice spike in volume. You have to have that spike in volume on the initial spike to the upside, but you're not acting yet. Then you see some consolidation, which makes this flag. Alright, so and the consolidation takes place on diminishing volume, so downtrending volume. So you have your flag pull on spike in volume, and then the consolidation, aka flag creation, on diminishing volume. Then your flag, you get a break above the flag resistance here, consolidation resistance, on a nice spike in volume. Typically you're going to retrace back to that flag resistance turn support, and then you just take off. So some of the things that these typically happen pretty quick. Like this, this upside move is going to happen very fast. If you're intraday, and say this initial spike took place in about 10 minutes, the consolidation took, let's say, 20-30 minutes, and then you get the upside tick, I'd say 5-10 minutes you're going to see that full measured move. And we'll talk about how to measure it in a second. If you're looking at more of a daily chart and you see this flagpole creation in a day or two, and then 5 or 6 days of consolidation creating the flag, then the breakout, it's probably only going to take a day or two for that actual continuation move to complete and hit its target. So typically what I've noticed in the past is that however long it takes to create that flagpole is typically how long it will take to create this actual, to complete your targeted move. So a couple important things. To measure the move, same thing, very similar principles as we've had before. You want to look at the actual height of the flagpole in this case. So, the start of the flag to the top of the flag, and in this case, if that's 10, then you're going to expect a 10-point move from the top of the flagpole or from the top of the flag consolidation. Another thing to mention, in these bull flags, typically when you're creating the flag, it will retrace 38.2% of the flagpole move. So you can pull out your Fibonacci retracement tool, which we haven't covered yet, but we will. And you could start the fibs at the bottom here of the move and stop them there at the top. Look at the 38.2% retracement level. If it gets below that 38.2% retracement level, your chances of actually getting a breakout on this flag are pretty slim. Furthermore, it's not really a valid bull flag. Same situation with the bull pennant, not very valid if you get below 38.2. So you put a little less emphasis on the validity of this actual price pattern. Lastly, the measured move, like we said, 10-point is your target, but I typically am a little bit more conservative as far as where I actually place my targets, my automated exit targets. So if it was a 10-point move, I'd likely look for an 8-point move before where I would actually place my automated exit on the target if I wasn't going to be able to watch it. If it was like a day, like a swing trade where I was going to be in front of the computer all day. If it's a day trade, I'll watch it, I'll adjust my stops accordingly as the momentum continues after the breakout. So what I would do is I would make sure that we have the volume on the spike, watch the consolidation, set an alert where I know that if it breaks, I'm going to be interested. Once the alert sounds, I'll come back to it. I'll take a look, reevaluate the situation. If I like the volume, if I see a nice volume spike on the breakout, I'll likely get long in the case of a bull flag. And when I start seeing some upside momentum, I'll just start revising my stop upward to either minimize my capital exposure at first, and then to start locking in profits as it continues to move to the upside. Take this situation, completely flip it, and that's a bear flag. Just complete opposite of this, just a mirror image of this, and that's a bear flag. So it's a continuation of a downtrend. You're going to see that quick spike to the downside, the consolidation. So really looks kind of like, there we go with my art again, and then boom. So that's kind of the flag right there, and there's the downside move. So that's a bear flag. But the difference between a flag and a pennant is simply the price action that takes place after the creation of the flagpole. So here we have an example of a Bear Pennant, and as you can see, we have the similar, we have the downtrend prior. This is a bearish continuation pattern, so we have to have a downtrend prior. You have the flagpole that takes place on nice strong volume. Got to have that volume on the creation of the flagpole. In this case, it was more of a consolidation, creating more of a flag. In this case, it's more of a symmetrical triangle, so it creates more of a pennant. So we have kind of the price action, that tightening consolidation pattern. So we've got that symmetrical triangle. So you can see there, pennant, flag, pretty simple. And the same situation here as was with the bull flag rather. You got to have, like I said, the spike in volume. You'll have this tightening consolidation. Your point of entry is going to be when you get the downside, the break of this uptrend support, if you will, in this case, and you got to have that spike in volume on the break. Then you'll start to see some continuation to the downside. Same situation, you typically get a retracement. After the initial downside move, you typically get a retracement back to that uptrend support term resistance before you see the full downside move. You measure it based on the height of the flagpole. So if that's 10 points, then your target's going to be 10 points to the downside. Same thing, I'm conservative. If it's a 10-point measurement, I usually, sorry, that looks awful. I usually put 8, I usually do about 8 points. I'm just a little bit conservative, and which is just the smart way to do it. It gives you a higher probability of success on the trade, and it doesn't force you out from greed. And lastly, same thing about the 38.2% retracement. You're typically not going to exceed a 38.2% retracement in these situations. So, and that's typically going to be on this first retracement, because the rest of them are going to be a little bit lower as it tightens into the pennant. So just make sure that you're using your Fibonacci retracements, which we'll discuss in the future, and that you are not exceeding that 38.2, because that's going to diminish the validity of the spread, or the price pattern. Lastly, the key points. Remember, it's a continuation pattern, so you have to have the downtrend prior to a bear flag or bear pennant, and you have to have the uptrend prior to a bull flag or bull pennant. Wait for the breakout to increase your probability of success on this trading this price pattern. Confirm the breakout with volume. First of all, you got to have the volume on the flagpole creation, but most importantly, you got to have the volume on that breakout. And then lastly, don't be greedy. Like I said, I'm more conservative with where I place my targets. Don't necessarily force it to make that entire move of the height of the flagpole. Just kind of manage the trade, and if you can't sit there and manage it the entire time and adjust your stops accordingly, then put your automated target in a conservative manner.